what's going on? Thanks for tuning in. This is Frank Chen with REIClub.com. I want to welcome you to our podcast. We're going to try something a little bit different by not putting numbers to our podcast, since we're going to be doing a wide array with things pertaining to this channel. So we're going to be interviewing real estate experts, investors around the nation, covering topics that you want to hear, and more importantly, asking the hard questions that you guys need the answers to. But again, unlike traditional podcasts where it's just purely audio based, we want to put you guys face to face with the people who are doing deals and making big things happen in real estate, so you know that you guys have it in you to do it as well. Now, I do have a special guest for you today. You probably see his handsome mug on here with us today, but before I do bring him on, I have a few announcements I want to make. The topic we are going to be covering today is a very unique topic and very profitable niche of real estate that what's surprising is what most investors are actually overlooking. And the kind of the information we're going to talk about today, you can really apply in your own business if you've never thought about it before, and really kind of diversify your portfolio, which I think is really, really powerful in this time in real estate. So another thing too is for our returning guests, thank you guys for coming here. We really do appreciate your support. Love having you here. Also, for our newcomers, it's welcome today. Thanks for spending time with us. If you haven't had a chance to explore REIClub.com, I do encourage you to do so. We have thousands of articles, hundreds of videos, really tons of great free information. And to really stay up to date with what's going on with real estate, what's going on with us, all you got to do is just sign up for our free monthly newsletter at www.reiclub.com/newsletter, and we'll let you know when anytime we have a new webinar coming out, new articles, blogs, anything on our YouTube channel. Definitely do that. And one last thing, if you guys are listening via iTunes, if you could leave us a review and a positive rating, that would be wonderful. It definitely helps us out, and it allows us to keep creating these videos for you. Now, with that being said, it is my great pleasure to bring on our very special guest. He is not a guru. He is an investor. He's a guy who's been doing this business for quite some time. And what we're going to be talking about is going to be mobile home park investing with the lovely Jefferson Lilly. Mr. Jefferson Lilly, are you there?
I'm here, Frank. How are you? And whatever I'm paying you, I'm doubling it.
All right.
That's been my most warm welcome lead in on any podcast.
Thank you. No, I'm. When we have guests on like you, we really appreciate it. You guys are the experts. You guys are taking time out of your super busy schedule to be here with us today. We're covering really a topic. Maybe you can explain to me a little bit more on why maybe you think mobile home parks is being so overlooked by even successful investors right now.
Yeah, this is a quirky niche, and first off, it's just not a sexy niche. It's not something most investors, would ever really want to talk about over polite cocktail chit-chat. Most investors, want to talk about how they're taking a, $1 million mansion and going to fix and flip it, or how they're investing in some more quote unquote normal aspect of real estate. They're investing in a self-storage facility, or they're investing in a strip shopping mall. This is just not sexy, so people don't seek it out. And then it's also, it's frankly not as large of a niche as apartment investing or single family house fix and flip or what have you. So word just tends not to get out. You don't, then have 10 people talking about it at a local, real estate club meeting. Everybody's talking about the single family house that they're fixing and flipping, or everybody's talking about the apartment complex that they are fixing and flipping. So it just doesn't build traction, because really, unless you're passionate about it and looking for this niche and trying to generate deal flow, you're just not going to come across it. So it is definitely an overlooked niche for a couple of reasons: size and lack of sexiness.
I think I've heard that before, the lack of sexiness. That's a very good point you're making. And but the thing is that it doesn't take away from the fact of how profitable it's been for those who have dabbled in it. So for those on the call today who have no idea who Jefferson Lilly is, give us a little quick insight to, how did you get started in mobile homes? Was it the first area of real estate you got into, or, did you kind of just stumble across it?
Yeah, well, Frank, as I say, when I woke up from the concussion, it just seemed like a good idea. But no, seriously, about a decade ago, I was working in high tech basically for
Okay.
most of my 30s at several different startups. I was a sales guy. But I'd always been interested in investing really since I was a kid. I think I bought my first stock at about age 17 when I still had to have my dad co-sign the trade ticket.
Oh,
This was
wow.
long before the internet or online trading. Anyway, so always been interested in investing. And I just started thinking about a decade ago, well, why don't I get out of the stock market a bit, diversify and buy some value-based real estate? I'm also a big fan of Warren Buffett, and I go out to Omaha roughly
Nice.
every other year for the big annual Berkshire Hathaway
Okay.
shareholders meetings. Anyway, so I thought initially that I would buy an apartment complex. And again, I like value. I figured it would be fine to get something outside of the Bay Area. I live here in San Francisco, so
Okay.
I was
Fantastic.
already looking and knowing I'd need to be looking in the greater Midwest to find, properly priced properties. But just in looking around like on LoopNet under multifamily, I'd see, looking in Des Moines, Iowa, I'd see 99 apartment complexes all priced at like an 8.5 cap, and then one mobile home park at like an 11 cap. And I thought, well, that's absurd. I'm not buying a friggin' trailer park. And I'd hit delete, and then I'd do the
Right.
search again in, Omaha, Nebraska, or Dallas, Texas. And, by about the third or fourth city getting hit over the head with this 1 in 100 multifamily property that would be yielding 2, 3, even 400 basis points more than apartment buildings, I finally thought, well, why don't I look into it and figure out what this is all about?
Right.
So that's how I got into it. It was sort of part by plan and part by chance. But there's some very interesting dynamics with the business, and I'm very happy that I did not invest in an apartment building and did get into this business.
And that's an interesting question. I mean, that's an interesting thing you bring up is that most people are under the impression, they just start, small in, single family before they start dabbling in what I guess you would call multifamily commercial
Yeah.
for mobile home parks. Now, for those investors out there who think that, obviously that's not the route you took, right?
Right. And one of the things that makes this a unique business is there's a very easy on-ramp. You don't have to start with a lot of money. It's possible to get into it with zero money. The way to get into it, again, with a real easy on-ramp is to simply buy a mobile home, or maybe you can find a park owner who gives you one that he or she just doesn't have the time to fix up.
Right.
And then either for free or maybe a couple $1,000, you get into the business, you buy a property, you probably fix it up, paint it yourself, maybe put in some new, we prefer vinyl to carpet, put in some new flooring, fix it up a bit. And so for a single digit number of thousands of dollars, you can then rent to own that house. That's what we'd recommend. Some people do regular rent, but rent to own it and create an income stream for yourself of $200 or $300 a month for what might be a $2,000 or $3,000 investment. That's not the way I got started. I got into it buying a park
Okay.
entirely. But I know one guy who got started again. He bought one house. He bought more. He got up to 50 homes. We call these Lonnie deals after a gentleman named Lonnie Scruggs, who
Okay. Yeah.
wrote a book called Deals on Wheels. But he got started as a Lonnie dealer, worked his way up to having 50 of these little streams of income, 50 mobile homes, and then he bought his first mobile home park, and he now owns about 5 mobile home parks.
Oh, nice.
Most of us who have been in this business recognize that owning the land, the mobile home park, is really where you want to be. But you can start small in the homes, or there are, small 5 and 10 pad mobile home parks, that you can get for, I've seen them for $50,000 to $200,000 for small parks. So that's not going to be out of reach. It wouldn't be inconceivable that you could find somebody at the level of a $50,000 park. maybe take 10,000 down and carry back the paper for another 40.
Mm-hmm.
So again, maybe for 10 grand, somebody could get into it, Anyway, so there are number of ways to get into this business. And then as you do build your wealth and can then start investing hundreds of thousands, or, we have a fund, we're now investing millions into it, but you can ramp up, as your financial resources and time allow.
So let me ask you, you just mentioned a fund of yours. So are you on the purchasing side still? Are you kind of focusing mainly on funding? Like, where are you right now in your business? And maybe you could give us an idea, like how many current parks you own?
Oh, yeah. Okay, sure. So we're up to 10 parks. We're in Wyoming, Kansas, Oklahoma, Illinois, Indiana, and Ohio. We like the greater Midwest.
Okay.
So yeah, our fund called Park Street Partners, we're buying entire mobile home parks. If some homes come with our acquisitions, that's fine. We're not specifically looking to own the homes, and we'll put them out on rent to own and help folks become homeowners. Right. But yeah, we're really looking to acquire the land. But yeah, so we're actively acquiring. We're also actively raising money. We've got a properly registered 506 Reg D fund, so it's open to accredited investors.
Okay.
And then we've done some joint ventures with non-accredited folks that have found their own mobile home park, but not been able to fully finance it. So they bring it to us, and they invest, and we invest, and we've mentored them, and they're now park owners. So,
very cool.
Yeah.
Well, I want you guys to stay tuned to the very end. We're going to give you guys a chance to reach out to Jefferson, provide some of his contact info, learn a little bit more about his fund. But mainly, we really want to talk about what's exciting about mobile home parks. Obviously,
Yeah.
You're saying it doesn't take very much to get in initially. Let me ask you this. You said you own a lot of properties are in around the Midwest area. And I think I would say a lot of investors would want to know, like, hey, I'm out in Texas.
Yeah.
How do I find out, if where I live is a good mobile home parks area? Are there certain city indicators that I should start looking for?
Yeah. So Frank, I believe you're in Austin.
Yes, I am.
Austin is a very good market. It's I'm sure it's very economically healthy. You've got the state capital there. You've got the university or several universities. Unemployment, I suspect, is around 5%. And probably the average house price, I would guess, would be a couple $100,000. So those are some key drivers. Fundamentally, mobile home parks are affordable housing. So this is a difficult business in places like Detroit, where a site-built house might be had for 20 grand, or heck, I hear some of them gone for as little as 5. But in markets like Austin, where, again, the average house price is a couple $100,000, that's average. At the low end of the bell curve, probably the cheapest house in Austin is $140,000, and that's still not affordable. We serve folks who have average household incomes of around $30,000, $2,500 a month. So spending roughly a third of their income on housing means they've got to have a housing solution that works at, say, $700 and under, $600 and under, all the better. So we can get folks into a home at that price point. Again, it's just tough for us to compete in a market where the average house price is low, because if somebody can get into a site-built house for $600 a month, and maybe zero down or a couple thousand down, then they're going to go that way. But that said, really the mobile home park business works well in most any town, say, other than extremely depressed areas like Detroit. The mobile home park business works well in probably, 90, 95% of America. The key things to be looking for, again, would be average house price, say, of $100,000 and up.
Okay.
Unemployment, let's just say sort of, 7% or less. Again, I think Detroit is more like 12. So if you've got reasonable unemployment and a reasonable average house price, and let's say there should be a super Walmart in your town, if we can be within 5 miles of a super Walmart, then we're about 99% certain that the park is going to work. Then it just becomes a question of price. And that's something that is difficult in your market, Frank, because you are in a sexy market, maybe not quite as sexy as being coastal California where I am, but Austin is a hot market. But again, reasonably high house price, reasonable to low unemployment. And if you're within 5 miles of a super Walmart, you've got a certain critical mass of economic activity. If you've got those three things lined up, then you can be about 99% certain that a mobile home park will work. We'll, of course, go ahead and run some test ads and move forward with the contract when we get all those items to line up for us.
That's so interesting. Like, mentioning of the Walmart, I forgot like which two companies are always like, when you see one company, you will always see the other one right beside it. And
oh yeah, it's like McDonald's and Burger King. McDonald's just spent
right
all the
across the
money
street from each
finding the ideal intersection to be at in every town, and then Burger King just came along and said, well, we want the location across the street.
every time.
So, yeah. So Walmart does really excellent demographic research, and they're putting their super Walmarts, the big stores, in places that are economically healthy. So again, we just need to be within 5 miles, maybe 10 of a super Walmart, and we're almost guaranteed that park will be economically healthy and remain full.
So again, you were mentioning about owning, you're in the business of owning land, right? You're not owning as many units as possible,
Right.
So with that being said, when you're purchasing a land of an existing park, right?
Yep.
Whether there are existing mobile home parks on there or not, I'm assuming that's something you would provide, correct?
Yeah, we're typically buying parks that are, well, so far have been at least half full, all the way up to 100% full.
Okay.
And then to the extent the park has vacancy, we will be buying houses wholesale, typically from some of the specialty finance companies like Vanderbilt and 21st Mortgage and Green Tree. They will have foreclosed on homes. We'll buy those abandoned homes, truck them into our park, tie them down, hook them up to the utilities, and then we'll put them on a rent-to-own agreement and help these deserving families become homeowners. There's no 30-year mortgage with us. We help folks own those homes typically in 4 to 6 years.
Very cool. So I'm guessing you're doing like seller financing. Is that what you guys are doing? Okay.
Yes. We do have some lines of credit and ways to tap and finance brand new houses from the factory coming into some of our parks. So we have done it that way, obviously, for our nicer parks. But we do have, I'd say at least half our portfolio are kind of more modest mobile home parks. And so we're buying these used homes, typically 10 to 15-year-old homes, buy them used, bring them in, again, repaint them, refloor them, put in some new heat and air, what have you, and make them good quality, affordable housing, again, typically at that 600 to maybe 700 price point at the high end.
Okay. And so there are other options for like cash flow potentials other than seller financing that you guys do, or it's just purely just for rent?
Well, so our homes, we're typically renting to own. We would rather not rent.
Okay.
One of the key drivers of this business that makes it better than, for instance, apartment investing or single family house investing is that by giving someone a shot at home ownership, you'll find that most of them will step up to the plate. They'll show pride of ownership. They'll stop behaving like a renter, and they'll really start caring for that house because they can see the light at the end of the tunnel. They know we're giving them a shot at home ownership in 4, 5, 6 years. So they take better care of the house. There's less maintenance for them. And in renting to own, we do require them to do the maintenance on their house. Certainly the minor things like a leaky toilet, a door lock that's broken. If it were something really major like a $3,000 heat and air system that they probably couldn't afford, we'll pay for that and then add that onto their payments and give them a brand new heat and air. But most maintenance items really are minor problems. It's the proverbial stopped up toilet or leaky sink. And so all those kind of minor things that would otherwise cost me $100 to $200 to send a plumber to go fix, we have the tenants take care of those themselves. And again, because they're taking better care of their home and maybe not dropping grease down the sink or who knows what into the toilet,
Right.
They find that their expenses drop. We have virtually no small maintenance expenses, still some of those big things. But on the whole, we greatly reduce our maintenance budget on the units. And again, we're selling those to folks, and in a single-digit number of years, they become homeowners. Their cost of living then drops to just what the lot rent is, which is probably around $275 on average in our portfolio. So they've stepped up into home ownership. They're not paying in our markets. A 2-bedroom apartment would be about $860. They're now a home owner, probably a 3-bedroom home. They're a home owner for about $275 a month. It's a win for them. Yeah. It's a win for us. We've got a very stable stream of income into the land. Just the $275 a month.
Yeah.
And frankly, maintaining land is about some sewer unstops, a little bit of lawn mowing, but it's really not expensive to maintain land. So we really we want to help folks become homeowners, and we just want to own effectively a parking lot underneath all those homeowners.
It's like one of those, I'm sure you've heard the saying where it's like no tenants, toilets, or trash. I think it's highly applicable to when it comes to mobile homes. I think anybody who's listening to the call right now who probably owns property, who's handled landlording, who's probably had to handle the grease being poured down the sink. This is sounding very, very appealing, Jefferson. It's one of those things where you kind of retroactively think or retrospectively look, man, did I get into the right business, or did I completely join everybody else and overlook what you're doing?
Yeah.
So this is just really fascinating stuff. Let me ask you, so typically, you're just owning land. There's just going to be mobile homes on the land. What type of things should investors look for when they say today first question for you would be, where can people actually go to kind of start looking for potential mobile home park lands that are being sold?
Yeah, so LoopNet is a place to go. There's also a website called mobilehomeparkstore.com.
Okay.
And then honestly, just reaching out to brokers direct is probably the best. Our most recent couple acquisitions, which were our Wyoming deal and our Ohio deal, were both pocket listings. These were listings that the broker had but did not put on any website. Now, you might think, well, that doesn't make sense. Why would a broker not want to sell a property? Well, brokers do want to sell property. When they put a property up on a website like LoopNet, if anybody like me, a buyer, has a broker, a buyer's broker, then the selling broker has to split their 6% commission evenly with the buyer's broker. And frankly, brokers don't like to see their commission cut in half. So the goal, and this is what we work on here at Park Street Partners, we want to be at the top of the list of brokers so that when they get a listing that they know they can sell, they just call us because they know we're not a broker. They know they're going to keep the entire 6% commission, even if, frankly, it's on a slightly lower purchase price because the deal didn't go through an auction. They, the broker, by knowing that they don't split their commission, the brokers end up in a better financial position for themselves. Okay. Indeed, perhaps to the detriment of a seller. But then also some sellers, frankly, don't want looky-loos coming through the park and disturbing their tenants.
I see.
Coming with their cameras and photographing things, and that can make tenants feel really weird. There are reasons why both a seller and a broker want to keep it quiet, and the broker will just make a call to whomever or the couple of whomevers are at the top of their buyer's list, people like us that they know that can close quickly and for cash. Although, again, we're very open to seller carry and creating an income stream for a seller, but we can close for cash. Brokers know that we don't niggle on price unless there's something really major
Okay.
that's come up through the diligence process. There's one other buyer group that always seems to drop their price by half the day before closing and say, take it or leave it.
Right.
We consider that very unethical. So, absent seeing something really major in the water infrastructure or the occupancy, absent something major in the diligence, we've never renegotiated price. We honor our word. Brokers know we've got money. My partner Brad and I are, we think, honest, fair dealing buyers. And so again, we do see pocket listings. So that's really what your buyers should be focusing on, is reaching out to the brokers and saying, hey, I'm looking for maybe a smaller park, or I live in Peoria, Illinois. I just want to own within 50 miles of Peoria. Whatever their thing is, their investment focus, they should just let brokers know that. And hopefully over the next 6 or 12 months, they'll get a call from a broker and they can move forward on something that's maybe not listed anywhere.
And you covered, man, Jeff, you're covering a lot of great points. I'm so glad we had you on today. And it's true, in our business, it's really, the networking, getting these type of pocket listings is very due to the relationship that you have, and of course the reputation that you have.
Yeah.
Being able to do what you say, being, avoiding the unethical, like the day before, dropping the price, or saying that everything up front to get the business, only to change it later on to make things complicated. It happens more frequently than people think. And that's why you only see a few of the more successful people rise to the top. I'm assuming, Jefferson, you're one of those guys, because, it seems like you're doing some pretty good business. 10 mobile home parks is quite a few. So let me ask you this question. I like to compare. I'm a single family guy. I look at homes a lot. I do all these rehab assessments and things like that. Since you're only in essentially the land business, what type of improvement type of things are you looking for, right? I can redo the asphalt, or like, what is it that you kind of feel are within your parameters when it comes to assessing costs before buying?
Yeah, so we have repaved one of the parks that had rough roads. Obviously, that's just an expense. Presumably, that does enable us to bump rents a little. Okay. But frankly, the two biggest areas that we see pretty consistently in parks where they need help, one is simply vacancy. We've got, for instance, 2 parks in Tulsa. One of them came with, I believe, 7 vacant mobile homes. And sorry, it was actually 11, but 4 of those were complete burnouts. That's the worst kind. That was really a safety issue for kids playing in those houses. So anyway, that park, we scraped out 4 homes, about $2,000 a piece. They had negative value, but we got down to 7 mobile homes that the previous owners just really hadn't put any money into, and they needed from really, I think a couple of the houses might have needed very little, $1,000, up to some of the houses needed about $5,000. But we'll invest that money. We will take that abandoned vacant housing, make it livable, get affordable, get that affordable housing into the market to families in need. And then this property this one's called Tulsa Estates. It had about another 20 vacant pads. So all the infrastructure's in, the water, the sewer, the telephone, the electric, the gas headers, all of it is in place at the pad, but there's just no home sitting on it. So we've been infilling that property over the last year, again, buying houses, wholesale, bringing them in, and fixing them up. And again, now expanding the supply of affordable housing. So infilling vacant pads is a way to generate dramatically increased financial returns. Another way, and this property had it, when we looked at the P&L, I believe there was something on the order of $50,000 in water expenses. Most mobile home parks are master metered for water. There's one giant bill submitted to the park. and it's really prudent business to then bill the water through to the tenants. This property had a $50,000 bill, obviously in the expenses, and then at the top line, it was only collecting about 30 in water. There were meters on the houses, and they were reading and billing tenants for their actual water usage, not making any money on the water, just billing it at cost. But obviously, there was either a $20,000 billing problem, or as we discovered, there were about $20,000 worth of water leaks.
Oh, wow.
So
Wow.
it's nice when both your bottom line and the environment line up. It's the right environmental thing to do to fix those leaks and conserve water. And obviously, again, it saved us about $20,000 a year in recurring expenses. At a 10 cap, 20,000, 10 cap, that means we increased the property value about $200,000 just for investing. Gosh, I believe we spent something on the order of $800 to have, I believe it was American Leak Detection, ALD, come out and find the leaks. They've got some sort of sonic tool that listens into the ground and can hear the leak. And
really?
So they found several leaks, but honestly, I don't think it was more than another $2,000 or $3,000 in actual physical repairs to stop that leakage. So for well under $5,000, just a little bit of diligence and doing things the previous owners were frankly too lazy to do. For spending less than $5,000, we improved the value of that property $200,000, and again are encouraging. We're just not leaking water, so that's better for the environment. It's better for our pocketbook. So water and infilling vacancies are probably the two biggest areas that we improve our properties.
So let me ask you this: what would you consider the lowest vacancy percentage to be appropriate for a mobile home park? It's kind of open. That's kind of a broad one.
Yeah, that's a broad brush question. So it depends. Frankly, if a seller is willing to carry back paper, then if the market were strong enough, we'd take a park that was just raw land and maybe didn't have a single house on it. And we would spend the capital on the houses. Now, that would almost certainly require two things. First, a strong economy where we could infill relatively quickly. That might be on the order of 4 houses a month we'd want to be able to infill. And it would require seller carry because, frankly, a park that had 0 homes would, of course, have 0 cash flow or really negative cash flow because presumably there's still property taxes at least. So very few banks would ever finance a deal that literally was empty or probably even 20 or 30% occupied. One of the things that makes this a good business is that financing is not super easy to come by, which means, again, if you can line up bank financing, you might be the only buyer for that property with bank financing if you've got that. But again, we'd need to see a strong economy and presumably seller carry for really low occupancy, 50 to certainly 70% occupancy. Then you can get bank financing. We'd still prefer seller financing, but again, certainly at 50 and 70% occupancy, we know we can get a deal done if the seller refuses to carry back any paper. We know we can get bank financing, and then provided our test ads pull well, which might be 30 to 40 responses a week, if we're pulling that well, then we can be pretty confident that we can infill it with homes. So, if our test ads were only getting 5 responses a week, probably it wouldn't matter. We just wouldn't do a deal that didn't, where our test ads didn't pull well. So anyway, kind of a long answer there, but between the strength of the economy, our test ads, and then depending on what kind of financing would be offered, that could mean we could look at it theoretically 0 on up to certainly 70% occupancy and build it from there.
Very nice. That's a very wide range of opportunity there. And I'm glad you're able to touch up on that because I know when it comes to commercial property, vacancy is huge, right? Well, it's already an established, physical building, 78% it's good, 50% you're like, whoa, I don't know if this is a good idea. So wow, like for mobile home parks, again, the land business, 0 to 78% is quite a huge range of opportunity. So that's awesome. Now,
Yep.
you did touch up on the funding side of things, and I think, we're going to be coming down to the hour of our call. I wanted to touch up on that a little bit more. Could you maybe elaborate a little bit more on the fund that you guys are raising? Is it one of those funds where if I was interested in buying, I could submit maybe like some information to see if I qualify? How does that work?
Okay, yeah. So with the Jobs Act of a couple of years ago, that's enabled folks like me to have funds. We register them with the SEC. We basically tell the SEC what we're doing. We're about to raise money, but the SEC, and we're about to advertise. And so I can talk about it here on your podcast.
Fantastic. Yes, sir.
If I really wanted to blow some money, I could get an ad on the halftime at the Super Bowl. But anyway, so we can advertise widely, but the restriction per the SEC is that we can only take accredited investors. That's folks with $1 million and up net worth, not counting your primary residence. I think any investment residences or vacation homes are fine, but you just can't count your primary residence towards that $1 million net worth figure. Or folks need to earn $200,000 a year if single, or $300,000 a year if married.
Gotcha.
So we've raised money in our fund this year from about 24 folks that are, and a couple of sort of family trusts and some self-directed IRA money. But all of those folks are accredited. And so we are now, again, actively pursuing properties. We are paying our investors an 8% preferred rate of return. And then beyond that, we split all profits 50-50.
Okay.
And something that makes us kind of unique is that Brad and I are not charging any management fees. So most folks are, more motivated to just charge fees and frankly, maybe do B quality deals because the deal sponsors know that they can charge fees for themselves, of course. We don't do that. Brad and I only charge a one-time 2% acquisition fee. But beyond that, again, we only get our 50% split of profits. So we only get paid after our investors first get paid, and they're fully secured in the real estate. So we've been, actually our first deal has been returning into the mid-20s, about 16% cash. We pay those investors 4% a quarter. We're likely to increase that next year, 2016, but they're already getting 16% a year cash, and there's been at least another 10% appreciation. So they're looking at definitely a sort of a 25 or better percent IRR. Wow. And that's pretty typical for this niche when you do it right. There aren't a lot of buyers going after this niche. And again, if you know how to infill and maybe correct some physical infrastructure problems, yeah, you can. I mean, we're grossing, I think, towards 35 or 40% on that. Again, we pay out a good chunk to our investors, and there's some for Brad and I after our investors get paid first. But yeah, getting to a 20-something% return is fairly common. That's not some exceptionally good deal. That's a fairly typical deal for us.
Well, after reviewing my mutual fund just the past couple of weeks ago, I think 20%'s not bad.
We think the stock market's likely to be 20% lower in a year, and we're likely to be 20% higher. And all of a sudden, for folks that view the stock market as their alternative investment, that could be a 40% spread in 12 months.
Jeez.
Anyway, we'll see. I can't predict what the stock market will do, but yeah, I don't. I'm obviously investing in this business. I'm
fantastic.
Not really putting capital into the stock market.
So I know. So my understanding, just to clarify, is the fund that you guys have, the way you guys are using this money, investing it in mobile home parks based on y'all's expertise, correct?
Yes, exactly. Okay. Yep.
So and the requirement for those to contribute money to your fund need to meet those criteria, which we were mentioning earlier, correct?
Yes, but we have joint ventured on 2 of those 10 properties where folks that are non-accredited have come to us. They've actually found a mobile home park, but it's been too big for them. And so they brought it to us. So we've put in money. They've put in money. And we mentor them and help them run the deal. But we'd also be open to somebody that just found a deal and didn't want to run it. They can just, again, bring it to us and we'll pay them a fee, or we'll let them invest in the business and we'll run it. And then, of course, we're sending them a check every quarter.
Very nice. Yep.
Yeah, as we say, we're open for business here at Park Street Partners. We're buying properties, we're partnering on properties, we're open to paying referral fees, and then we are raising money from accredited investors. But again, folks that might find their own deal then wouldn't have to be accredited if they brought it to us and we found a way to partner on it.
That is great news to hear. So it seems like there's multiple ways to work with your organization, Jefferson. I think that's fantastic.
Yep.
We love talking about new topics. We're always focusing on wholesaling, single family. It seems like it's the core topic for most newer investors. So I do encourage those on the call today, who are listening to this podcast to really kind of investigate this new area of real estate and to kind of give Jefferson Lilly's business take a look at his website. Where can they go check out some more information about you, your website, get in contact with you, Jefferson?
Yeah, so the website is parkstreetpartners.net. Okay. You'll see right off the homepage, resources both for newbie investors. You'll also see links to actually find our fund there for folks that might consider investing, and we have our bios there. parkstreetpartners.net, N-E-T. And then they can also, frankly, connect through LinkedIn. I'm on LinkedIn. Okay. My partner, Brad Johnson, is on LinkedIn. And then we run the largest mobile home park investors group on LinkedIn, simply called Mobile Home Park Investors. And you can just find that right off the homepage. Search for that at linkedin.com. We've got closing in on 3,000 folks. Nice. In that group, and we trade some deal flow and general advice on how to find and manage and potentially sell mobile home parks there at Mobile Home Park Investors at LinkedIn.
Very awesome. Thanks for that, Jefferson. So Park Street Partners, guys, thank you so much, Jefferson, for your time today. For any reason you guys need to get in contact or with Jefferson directly through REIClub, you can send us a contact form and we'll be able to connect you that way. We're all about community here and making sure you guys are well taken care of and really put you guys in the right direction. So with that, again, if you're watching this, please leave us a 5-star review. We appreciate it. Leave us positive comments. Give us a like on YouTube if you're on there as well. Again, mobile home park seems like it's a fantastic way to build great cash flow. Again, you're investing in land, not dealing with tenants. You're not dealing with any kind of, trash, all that stuff. So this is just a fantastic opportunity for investors with all types of experience. So again, Jefferson, this was a pleasure. You were great. You went above and beyond what I expected, what we were going to cover today. So this was really fun.
Thank you, Frank.
Absolutely.
Great to be with you.
Great. So you guys take care. We look forward to talking to you guys next time. Take care. Good investing, and bye-bye, everyone.